Welcome everyone. Thank you for joining us this evening, and a special welcome to all those attending an information session for the very first time. Welcome. If there is stuff that you don't understand because it is your first time, not to worry, just drop us a message and we will set up a time and we will chat through it with you. So nothing's ever complete without some housekeeping. So this session is provided for information and education purposes only, and the content isn't intended as a substitute for your own research, and also if you need to seek help from an advisor or a licensed professional. Cashbox Global is authorized and regulated in South Africa and in Mauritius, and we do not offer financial advice. Tonight, we're launching a new growth note, and Andrew's going to be taking us through some of his insights on the underlying basket, and then I'm going to cover how the features work. The performance of any structured note depends on the terms of the contract being met. And while there are built-in protection features, structured notes are not risk-free. So you do need to be aware and understand those risks. At a glance, the note is issued by BBVA, and it is targeting a 12% per annum return, accumulating at 6% semi-annually. The note must autocall to pay out the accumulated coupons, and the trigger for the autocall is set at 100% from 6 months. It does have a low hurdle that's set at 90% at maturity, and that is in the event that the note doesn't autocall before that. There is a 60% capital protection barrier built in, and if you don't understand any of this, not to worry, I'm going to be going through all of it in more detail later on. The underlying basket is made up of 4 indices, which Andrew's going to run through now, and the closing date for the investment is the 20th of August. This is when you need your trading platform to already have your instruction, and your funds need to be cleared by then as well. For those who don't have a trading platform as yet, if you'll just let us know, we will send you a list of popular options that many of our investors use. Alternatively, the list is available on our website. So with that, I'd like to call on Andrew.
Thanks, Joel. Can you just stay on the slide for a minute?
Sure.
Hi, everybody. Capton got the first sort of feelings of summer today, which was great after what seems like a pretty cold winter. At a glance, Jules ran through the metrics, and she'll take us into how it works a little bit later. The big difference for those who regularly attend our webinars is that we generally, Cashbox is known for selecting 4 individual stocks aligned to a theme or a particular trend, which is very concentrated in terms of there are 4 companies that literally the note depends on its payoffs from. This is very different. If you look at that big blue box, there's 4 indices, and we're going to go into them in some detail. Graham is on the call tonight from IDAD, and these have proved exceptionally popular. With, Joel, can you ask somebody to mute?
Yeah, if you wouldn't, I was going to mute.
I'm muting. Okay. And Graham's on the call from IDAD, and this is actually an IDAD note that we were invited into. Quite a few clients have been asking, how do we de-risk even further portfolios in terms of growth, etc., when the concentration of 4 individual companies is quite concentrated. So 4 indices, and we're going to go through them as I mentioned. Australia, Switzerland, Italy, and the Nasdaq, which is the tech-heavy US index. Now, that's 20th of August, that's 7 days, so it's a real hop, skip, and a jump on this one. So we're going to keep it short and snappy as well in terms of the presentation. So let's go through why indices work very well, and Graham can probably add a little bit at the end here. So moving ahead, we always talk about diversification. And diversification in this instance is that we've got the Latin quad 4 index approach. So we're using 4 indices as opposed to what we usually use as 4 stocks, 4 individual companies. And if you think about it, 4 companies is a very narrow sort of lens on a particular theme or approach or theme. So effectively, an index makes things a lot wider. I'm going to go into that in terms of quite some degree of analysis, because that's really what differentiates this type of note from perhaps a single stock note. So diversification, it's something we always advocate. We always say, think about it, look at these notes in terms of your overall perspective, your overall outcomes of what you're looking for. That's very important in terms of your portfolio design. So this is where I said earlier, we've introduced some animals into this particular approach. And being an African company, if you want to call it that, we've lumped together, thank you, AI. I'm sure this is produced, Jill produces out of an AI. It's really, as you can see there, it's a diverse grouping of animals, okay, sitting on some savanna somewhere. You've got your sentries standing there, the tall giraffes keeping a peep out for predators lurking in. You've got the sort of heavy artillery, the buffaloes in the back there. You've got the very sound sensitive and smell sensitive other animals, the antelopes and the zebras, etc. So there's a mixture. And that's essentially the DNA of an index. It's a mixture of different companies, different sectors, different geographies. So I hope by the time I'm finished, and I think the slide pops up towards the end when I hand over to Jill to explain how it works, you'll get the meaning of this mixture of animals, as opposed to just having 4 giraffes or 4 buffalo or 4 zebra. Okay, so let's go for it. Okay, the next slide is we talk about index, and index is literally the companies that are formed on a particular grouping on a particular stock exchange. We've mentioned them. We're going to go into some detail. Essentially, index investing, if you invest in an index, you're being quite passive in terms of you buying the complete index. And there's 3 core principles. So it's quite passive as opposed to being more active, overweighting something or trying to go long on a particular strategy. This is like you're looking to buy the index. Whatever the index does, you're going to get back. So the passiveness or the passivity, you're not looking for individual winning stocks, which is a little more on knitting, if I can call it that, in terms of we thematically look for those stocks that are going to do well or certainly not decline by 50%. We're not stock pickers. So we're just looking for companies that will be solid, carry on, even if they have like a 50% downside, for example, we're going to be fine. So you own the entire basket as opposed to 4 particular securities. And the banks, you saw a 12% coupon. The banks ordinarily will pay higher coupons for a more risk-on approach when you're only choosing 4 companies because your concentration is on 4 companies. Your risk appetite goes seriously exponential when you're looking at that situation as opposed to a wider index. Conversely, they'll pay the lower coupon because there's less volatility. The last point in terms of reduces concentration, it lowers exposure because you're basically getting all the winners and the losers in one particular pot. Not everything is going to go up. Not everything is going to go down. And the beauty of an index is that it aggregates. It literally takes the winners, the losers, plus and the minuses, and it gets a net result. Okay, as opposed to having 4 companies, and if one fails, then effectively that could actually jeopardize the performance of the other 3. So here you get the benefit of what the index is doing, not one particular company. But that comes with a caveat, which I'll explain a little bit later. And there we go back to that word diversification. We are spreading risk further. In the WhatsApp group I said today, this is another way of reducing risk in terms of a note, for example, because you're moving it away from a very narrow lens into more of a sort of wide angle lens in terms of you taking all the companies in that basket on board. Okay. And also the bank is very comfortable allowing us a 60% protection level. We mentioned that in one of the previous slides. Again, Jill will take you through that. At 60%, they'll allow a 50% on a more highly concentrated stock basket, if it's just 4 individual companies, because the risk is greater. So you have a slightly deeper protection. In this, the volatility is actually going to be smoothed out to a large degree. So the important outcome in the blue box is that no one single company or no asset carries the full burden of a potential loss. Here you've got the aggregates. You've got, as I said, the winners and the losers, plus you add them together and like a P&L, profit and loss balance sheet. And at the end of the day, as long as we come out above 60%, our capital is protected. And if above 100%, we're going to pick up these rather attractive coupons given that it's an index-based note. Many indices-based notes, you're looking below double-digit numbers. You're looking at 8-9%. Graham can allude to that later. So let's have a look at the 4 underlying indices, because these are quite important. The first two I really, really like because I know them very well. They sort of got the moniker or the title of safe haven. I don't think there is any safe haven in the world anymore. Like a currency, there's no really safe haven currency, there's no safe haven commodity, but they're known as safe havens perhaps because of the lower volatility that the companies that are listed on those particular exchanges carry. So, for example, and there's a brief description, the ASX is the Australian 200 largest by capitalization companies. In Australia, the SMI is Switzerland. That is linked to only 20 companies. And the MIB, the Italian, is 40 companies. And the American Nasdaq tech sector, excluding financials, is 100. Okay, so again, some of the concentrations are down to 20 and 40 and 200. There's a slide I've thrown in the end here, which is, it just shows you sometimes the anomalies of an index that sometimes can get overrun by a concentration, and that's the S&P 500. We'll do that right at the end. So those are the 4 indices. They've all done spectacularly well in the last 18 months. You can look at any chart, and these guys are flying. They've done very, very well. Interestingly, because the Nasdaq, we all know, has been driven by technology, the AI boom and trend. Most of the others, because of their type of listings, in terms of the companies that are evident in those countries, they have different sectors. And that's something I've been banging on quite a lot, and some of our notes have reflected that, is that we don't want to be just purely focused on the tail strings or the tailcoats of AI and technology. We need to have other alternatives, because if AI does, sort of not implode, but if AI does go soft and all these mega spenders suddenly can't find buyers, then there's going to be problems there. So quite a few of our recent notes have focused on companies that have defensive properties, even if AI sort of has a little bit of a pinprick in its bubble. But those are the particular companies. They're all in very well regulated jurisdictions, very robust jurisdictions. They all have very different approaches in terms of the themes and the sectors that they portray. So let's have a little look at that, okay? And the advantages of using 4 indices. So again, this word diversification, it keeps coming through, I think, just about on every slide. And every single advisor, if there are advisors you're talking to, which would certainly be selling you that or advocating diversification is key. And I certainly believe this is a note that we could insert into our portfolio of notes, or a client's portfolio of notes, if you're sitting there contemplating for yourself, because it creates a different diversification to the single stock approach that we've been using. So let's have a look at this. Let's take Switzerland, for example. That's 20 companies that are represented on this. We'll have a look at some of the companies just to give you a sort of feel of how big these companies are. These are sort of household names, not to say that they can't fail or there could be problems, but certainly these are major, mega, systemically important companies, either regionally or globally. And certainly they call it, they have a free float market capitalization. So basically what happens is that the biggest companies in those particular jurisdictions that are listed in those countries are included on their stock exchanges. But then they cap it at a weighting. And you can see Italy is 15%. So no one company can have more than 15%, say, in terms of its weighting, okay, which is quite important. It's still quite a big number, but it's quite important. Again, remember the S&P, and I'll show you that slide, which is quite interesting. Switzerland is capped at 18%, the Nasdaq at 20%, okay, and these get rebalanced every single 3 months, every quarter, to make sure that they stay within these limits, because the regulators in those countries don't want one particular or a group of companies overwhelming a particular index, which can happen. And we've seen that happen. And certainly it's happened in the S&P. And then the Australian index, they don't have a restriction on that. It's a little bit like the S&P. They can actually just, you can get a couple of handful of companies dominating. So the 4 indices you look at the flags, it says something. You've got geographic dispersion here. You've got geographic spread. Most of these companies are earning their income globally from all sort of points of the compass, not just from Switzerland, Italy, etc. They have global revenue streams. So we haven't chosen one index. We've chosen separate indexes, two in Europe, one in Australia, and one in America. The larger companies within those particular exchanges will have an influence, but you'll see the type of companies and the actual percentages at the moment. That's quite important, I think. And I think that last point in the blue block, the 3 out of the 4 certainly cap that over concentration of a couple of companies dominating and just running right, which can happen in these mega companies that just get so big so quickly. And we've seen that happen. So this creates, for me, a very solid platform for diversification in terms of you're getting a whole range of companies through a whole range of sectors, running on different themes, running on different currencies, etc. So it's right across the board that you are literally cutting the onion and you're looking at all those concentric rings and you're getting everything there. So let's just have a look at some of these companies to give you a sort of sense of how big these indices are. So this is Switzerland, okay? And I've just taken the 5 or 6 or 7 or 8 largest companies. So these are sort of companies that you might be familiar with. Nestle, obviously, UBS, the banking group, Roche, pharmaceuticals. But I think as you read through it, there's a nice spread or a healthy spread of different sectors. You've got a wide range through healthcare, industrial, robotics, banking. Banking is a theme that comes through all the particular bourses, indices. And that's why I think we've been particularly successful with our banking notes, because globally banks have just done very well in the last 4 to 5 years. So you can see they've got a very mixed spread and balanced spread: healthcare, pharma, food and beverage. You'll see some of the same themes cropping up. So if you go to Australia, which is a very different index, on the next slide, Jill. Australia's always been a very resource-heavy country in terms of they do a lot of mining. So you'll see mining pop up. They call it materials. So there's BHP, Broken Hill Properties. You'll see further down Newmont, which is actually an American company, but it's listed there as well. It's the biggest gold mining company in the world. We've included that in some of our notes as well, done very well. And further down, Rio Tinto. These are global companies with footprints in multiple countries around the world, earning a really diverse range of income streams. But you'll see again there, banks come up very strongly. And obviously there's a consumer discretionary. So you're starting to get a feel of all those animals standing together. They're all sort of disparate. They all have different things. They all bring different attributes and strengths to the party, in some instances weaknesses. But certainly these are the sort of big names. If we move along to the Italian side, I think you all know the one, Ferrari, number 4. UniCredit, again, banking. Intesa Sanpaolo, banking. So again, very, very strong on the banking theme in Europe. And again, a mixture of sectors and themes and corporates, some of whom are really, really big in terms of, if you look at UniCredit, for example, it's certainly the second largest to Intesa Sanpaolo in Italy. There's an acquisition it's busy with at the moment. If that acquisition goes through, it'll certainly dwarf the Intesa crowd. It'll probably become the second or third largest bank in Europe, never mind Italy, in terms of its hopeful acquisition of Commerzbank in Germany, subject to regulatory approval now. So there's a lot going on here. There's energy in there. There's Ferrari. There's cars. There's more energy in any spa. So it's a nice mixture. You're starting to, as I say, get everything. Let's have a look at the last one, the Nasdaq. So Nasdaq is a little different as an index, because here they exclude a lot of stuff. This is technology heavy. This is your semiconductors, your microprocessors, your AI stuff. It's all the companies that are very technology integrated, and you'll see the names there. And these are probably the names. These are the biggest companies in the world now. Your Nvidias, your Apples, your Microsofts, those 3 change positions on a daily basis, literally. But again, you'll see here the spread, because it's a technology index. It hasn't got that blend that the other 3 have got, but this is a driver. It's certainly a driver. The world's economy at the moment and the world's markets to a large degree have been driven by the Nasdaq and what's happened with these companies as they've driven artificial intelligence, the technology sector, the semiconductors, all the picks and shovels that go into making this whole new world that we're going to be living in. So again, there, you can see these are household names: the Amazons, the Microsofts, the Metas, the Alphabets, the Googles, etc. So very strong names, very powerful companies, but this is more niched as opposed to, let's say, the Australian, where you've got 200 companies spread over a whole range of different sectors, as you have in Italy, etc. So this is the whole spin on index, is that you'll have winners in here and you'll have some losers and some people who just sort of bumble along, chug along. But the fact of the matter, at the end of the day, when you look for performance, it's aggregated. You get a net result. It's not reliant on one particular company knocking the other three out if it's a three-stock basket, for example. So I won't say this is safer. I would certainly say the volatility is far reduced, okay? And hence sometimes the banks aren't prepared to pay you big coupons because they know the volatility is produced and they know this is a particular product that's going to literally chug along. And Jill's got a very good slide to show some of the performances of these. Let's have a look at the anomaly, as I call it, because I keep talking about indices. You get the good and the bad. You get everything thrown together. Let's have a look at the S&P. So Standard & Poor's 500 is the 500 largest market capitalized, the biggest companies, let's call it that, take out the speak, in the United States. And this is right across all sorts of companies. You might think you're looking at the previous slide, which was the Nasdaq. It's because these companies have so dominated both indices. It's only JP Morgan who's slipping at the bottom there. We actually say, well, hang on, we got a non-technology company. We've got banking and financials here, which is quite interesting. But you can see their weightings there, very, very, very strong weightings. You add it all together and you get this ridiculous situation on the right-hand side of 36% of the 500 is driven by these companies, okay? So these 10 roughly make up 500. So that's, okay, it's not half, but it's more than a quarter. It's a third. And the concentration of that 500 suddenly narrows because these 36% are actually driving literally this particular index. So it needs to be looked at quite carefully, and you need to understand that. But generally speaking, I would certainly suggest, this is the engine room. This is the world economy in an index. There's no, it's the world's biggest economy. It's the world's biggest market. You have to take cognizance of something like the S&P. What we have done, in this particular note, what I'd have done, is that they have taken the Nasdaq, which, as you see on the previous slide, is pretty much the top 9 companies, and we've rather included that because we've got all the other exposures through banking, materials, mining, energy, etc., in the other bourses. So we're very comfortable in utilizing the Nasdaq in this particular note. So that, if you move on to the next slide, maybe explains my animal picture, because you've got all these different constituents in your basket, as opposed to, as I mentioned, either 4 giraffes, 4 buffaloes, or 4 antelope. This is it's an opportunity, I certainly believe, within a portfolio to see whether if it's a growth portfolio, to say, well, I'm certainly taking out the volatility where one stock could really sink, the entire basket, irrespective of how well the others do. And that is the risk that one takes with a four single stock basket. If one doesn't perform at the end of the period, at the end of term, well, that means it tarnishes the others, and they all fall together. Whereas this approach is that there's this constant aggregating of term, where are we, winners versus losers, net result. So it's a much less volatile situation. So I'm going to hand over back to Jill. I hope that explains indices versus single stock investing. The indices is far more less volatile versus the more aggressive single stocks. But Jill will take you through the next slide, which really will give you some more insight into how the actual product works.
Excellent. Thanks, thanks, Andrew. So if you do have any questions, we're going to open for questions at the end. Please drop them into the chat, and then we will go through each one of them and answer them as we go along. So let's have a look at how the note actually works. So this is a nice little depiction of it. And what we're going to do is we're going to look at the top of the graph. The note has a maximum term that covers 10 periods. So it's a 5-year term, and the coupons are going to accumulate at each 6-monthly period. The strike date, which is the date that the underlying indices are going to be valued, that happens and it becomes the start value. This is the value that is going to be used as the reference point for all future observations throughout the life of the note. From the first observation, and at 6 months, the autocall feature becomes active as well. As I said, you need the note to autocall or mature early in order to release the coupons. On each observation from 6 months, they're going to measure whether the indices are at or above their start price, because the autocall trigger is set at 100%. If those conditions are met, then the note will mature early. The investor will receive their capital back together with the accumulated coupons. If the conditions aren't met, the note's simply going to continue to the next observation date, where this test is going to be repeated. This process is going to continue until either 1, the note autocalls, or it reaches its final observation date, when something called the low hurdle feature, which is built into this note, actually drops that autocall trigger level down to 90%. So it's going to give you a 10% margin for you to help you get the autocall over the line. If it doesn't autocall through the low hurdle mechanism, this means that the indices are below 90% of their start price, so their value is then going to be compared for the capital protection barrier, which sits at 60%. And as long as those underlying indices are at or above 60% of their start price, the full capital is going to be returned. So that means that there's a 40% margin that they can drop by, and your capital is still not impacted in that area. Unfortunately, if it doesn't autocall, you're not going to receive the accumulated coupons, but you will get your capital back. So there's been back testing on this underlying basket, which shows how the investment would have performed historically using data from previous potential strike dates and observations. So although past performance is not an indication of future performance, it can give some insight into how the investment would have performed historically. This backtest was for a 12-year period and shows the data for a full 7 years of 5-year products that could reach full term. And of the 1,752 product scenarios that were tested, 96.35% would have autocalled, so you would have received those coupons at the varying observations, with 100% of them returning full capital. So even the ones that wouldn't have autocalled would have returned full capital with no capital protection barrier breaches. So we always like these types of notes when we can have the back testing done on the indices. One of the things we also love about structured notes is that we know exactly what to expect and when. So this is done through the observation and payment schedule that you will find in the fact sheet. Every structured note has it. And what this is a list of observation dates and the payment date should the note autocall. It also shows the required trigger levels for the autocall during the term, that low hurdle that I mentioned at the final observation, as well as the capital protection barrier. And as mentioned, the note closes for investment on the 20th of August, with the strike date, that's the date that they measure the values of those underlying indices, taking place on the 24th of August, and the issue date of the product on the 31st of August. If this is interesting to you, and if you would like to go ahead, your next step would be to complete your expression of interest. The link is in the chat. I believe Logan has popped it into the chat. Alternatively, it is available on our website, or you can just pop an email through to support@cashbox.global, and Logan will send that link through to you. Once we receive that, we will send you the ISA number, which you will need in order to place the order with your trading platform. And as I mentioned, if you don't have one, just let us know and we can send you some popular options We are platform agnostic. And then once the note is running, we're going to keep you up to date after each observation and provide ongoing training and support as you need it. So that was quite short and sweet, but what I'd like to do now is open the floor for any questions. I'm going to just stop sharing. So I just want to go through here. Are there any questions?
Maybe while you look for questions, Jill, I'd just like to add one thing that I sort of touched on but didn't really mention, is that the four indices that have been chosen have had spectacular success in the last sort of 18 months. They are sitting at quite high levels. So the question that one must pose, I would suggest one poses, is that is this momentum heading in the same direction, or is there going to be a correction? Is it going to come backwards? By natural causes or by just market people taking profits, etc. And so this is the difference with an index, a geographic index, which everything's interlinked globally, is that one has to have a bit more of a macro view on the world. In other words, one needs to sort of think about, are global interest rates moving upwards, or are they going downwards, or are they staying the same? Will this never-ending war in the Middle East, which is causing these energy shocks and this crisis, will that actually sort of dissipate and actually fizzle out or stop at some point in time? The same for Eastern Europe with the Ukraine and the Russian conflict. So there are a number of bigger picture sort of scenarios that one has to think about, because obviously, as I mentioned, all these indices can't be looked at as silos. They're all interconnected. All the companies have a global footprint. And they source their revenues globally. So one needs to have a fairly positive view, I think, going forward, that as long as he's indexed to collect the coupons, it's got to be, as Jill said, during the term, it has to be at 100% on one of those observation dates. Or if it doesn't happen, it's got to be at 90% of the starting prices on the 25th of August 2031. So the world is going to be a very different place as we note on a day-to-day basis. Things move very rapidly, and hence the sort of sentiment and momentum is quite important, especially in America, which, as I mentioned, unfortunately or fortunately, we have to deal with it because it is the global marketplace, and they do shake the stick, whether it be tariffs or whether it be anything else. So, and America will have a new president during this period. Midterm elections start shortly, towards the end of this year, and in 2 years' time, we could very well have a new president if the constitution isn't changed. But so I think one needs to have a fairly positive view on global macro, we call them macro events in terms of macro movement, that will these indices be at an equivalent level or above those levels as we go forward. To literally collect the coupons, because that's how this note works. It works on a situation of it has to be at 100% or 90% eventually of its strike prices. Whereas in the single basket stock notes that we produce, we have aggressive autocall reductions, which basically mean every observation, that threshold drops because there is volatility in those stocks. This is slightly different. So one needs to just take a little step back and say, what's my global view? Are things going to chug along, or are we going to a 1929 recession? Graham, is there anything you'd like to add?
Well, I was just going to say there, Andrew, you hit the nail on the head. You really did, because I'll just put into the mix there that, as always with an indices, and this is not, sort of Cashbox's, main core business strategy, as you've explained. With indices, we all know that over the long term, indices go up. Now they will go like that, but over the long term they go up. For example, the FTSE was launched in 1984, the FTSE 100, and since 1984, guess what? It's increased in its index value. We know around the world, we know with the simple economics that companies will continue to grow over time. everything goes up, but it will have that peak and trough aspect. So, as you absolutely nailed it, Andrew, in the sense of this is a 5-year term note. What do we think of those 4 indices in this 5-year period? And I would suggest to you that the Australian and the Swiss and the Italian markets, as have been demonstrated over time, are pretty much your sort of general drift upwards. The Nasdaq is the one to watch, and that's where your worst performing element within the basket is always the one that you need to look for. So it really, in my opinion, and I think generally you would appreciate this. I was talking to some discretionary fund managers only the other day about this matter. That's the one to watch. What is your belief over the next 5 years with regard to the Nasdaq? And the great thing about this is that the Cashbox has had webinars in the past. Cashbox has participated in the AI movement and the tech movement, and with some brilliant notes. And we can see from this picture that essentially there is a period of time, and probably we'll look back in the future and look back at this point in history and say this was a period where there was a lot of activity in this space, in this tech space. And we've got the Nasdaq here in this basket. Now, nobody's got a crystal ball, but that 5-year period, is this the 5-year period where the Nasdaq is going to shoot the lights out? Or is it where the Nasdaq is going to take a little bit of a retrenchment? And where is it going to be in the next 5 years? I suspect it will, as you rightly said, Andrew, it will have peaks and troughs. And they are at pretty high levels across the board with those companies that constitute the Nasdaq. But the fundamentals, and this is exactly where you explain, what are your fundamental beliefs of this 5-year period going forward within these segments? And that's the real issue to look at. Now, I talk about discretionary fund manager. I was talking to quite a few the other day. They turned around to me and they said, essentially clients, they can't explain enough to clients how hard it is to eke out a 5% return in a portfolio over a many year period, let alone a 12%. They just sit there aghast when I turn around to them and say this accumulates 12% per annum over the term. And they do sit there and they say, well, that's just quite phenomenal. Coupled with the fact that the discretionary fund manager will sit there and say, yes, I'll charge you 1.5% per annum for the pleasure of me managing your portfolio. Oh, and also I'll charge you a minimum, sorry, not charge, but enforce a minimum threshold level of anywhere between $250,000 and $500,000 to be able to allow me to manage that portfolio. So all of these issues go into the melting pot to say, well, this is I believe, an excellent opportunity to get exposure to a diversification of risk with an enhanced return. And it's precisely that you've expressed there, Andrew, with the knowledge that yes, we've had a very buoyant period, but as I say, we've picked out 3 of the indices that you have quite rightly explained are real backbone stuff. Australia, Italy, and the Swiss bourses, and we've got that Nasdaq 100, which is the real interesting one to keep an eye on. So yeah, but really just to add to your points there.
Great.
Thank you.
And we do have a question. So it's just to clarify. So the question is, if the note does not autocall, the capital will be returned if above the capital protection barrier. You don't receive the coupons that accumulated along the way. If the note doesn't autocall, be it 100% during the term, or at that last observation where the autocall trigger drops to 90%, if it doesn't autocall on either of those periods, you're not going to receive the accumulated coupons. It must autocall to receive the coupons. And that's the difference between your income notes and your growth notes. And then just to pick up on something that Graham mentioned, the return that's quoted, the 12%, that is net of any fees. There are no additional fees that come off other than your trading platform. They will charge you to go into the note, and then they usually have a monthly platform fee. But that is outside of the actual note itself. That is the service that you're paying for from the trading platform. And then Sherman said, sorry, and then Andrew Sherman said the elephant was missing.
Yeah.
There's always an elephant in the room.
Always. But no, I think that, again, guys, but, very clearly explained. I absolutely, Jill, the back testing there is something that we really do drill into, and the ability to be able to statistically auto call on a 96% level, again, is something that obviously Cashbox is like, wow, okay, yeah, this has got our attention. So very, very, very well put forward, very well explained.
Great. So if there aren't any more questions, if you are interested or wanting more information, you can pop us a message, send an email through to support@cashbox.global if you've got any questions. If you would like to participate, you'll just complete the expression of interest form and we will take it from there. The recording will be going out we are on Thursday, so beginning of next week, the recording will go out together with all the links, but all the information is available on our website as well. So with that, thank you very much for this evening, and thank you for joining us.
Thanks, guys. Well done.
Well done, guys. Cheers now. Take care, everybody.